making your way in investing, or planning on retiring, either way, this video was made for you. Many people want to earn passive income with dividends and make that their number one source of income in order to not worry about working again. The problem is they don't know how it works and don't know where to start. But don't worry, after watching this video, you will feel as if you owned the whole market. Hi, I'm the Matrix Money Maker, and today's video is about how to invest in dividends and the best strategy to make fortune in it. Make sure to subscribe and watch until the end, because at the end I give the best dividend strategy used by the richest investors. To start, why do companies pay dividends? Well, when a company makes money, they have a multitude of options to decide what they want to do with their money and what the best thing to do with their money is. The number one option is to invest all the profits they made during the year in order to improve their business by making better products and thereby increase customer satisfaction. For example, when a technology company makes profits during the year, they will reinvest the money in making improvements in their research or improving the technology and software of their product. The second option is share buybacks, where the company decreases the amount of shares or stocks on the market, and this results in an increase of ownership for the investors in the company. And then there is the third method, which is to essentially pay out shareholders. Usually it happens each quarter by the use of dividends. And dividends are a great way to make money in the stock market, which is why we're going more in depth in it today. In fact, they are a great financial opportunity for investors. The first step in knowing how to invest in dividends and which dividend to choose is knowing what a dividend yield is and how to choose and use it. The dividend yield, or dividend price ratio of a share, is the dividend per share divided by the price per share. Simply said, it is a company's total annual dividend payments divided by its market capitalization, assuming the number of shares is consistent. The dividend yield is also expressed as a percentage. When choosing a dividend yield, it is not necessary to opt for the highest yield that you can find on the market. However, when deciding the dividend yield you desire, you should take in consideration the proper amount of growth, which represents the possibilities that the company has to grow or to last on the market for a long time if it is already a big company. It is always a good idea to choose a company that has a lot of cash or liquid assets, so you're sure that in times of crisis, the company will not go bankrupt and stop paying you your dividend yield. Moreover, you should also look for the stability of the company and see whether the stock of the company or the revenue fluctuates a lot. You guessed it, the more stable a company is, the better it is for the dividend yield. Those are the reasons why most people rather invest in companies with a 3 or 4% yield than in company with 12% yield. The mistakes some investors make is purchasing shares in a company with a high dividend yield. On the surface, a high dividend yield could be just perfect for your investments, but there are some reasons why you should probably be careful when investing in such companies. The most common reason why companies propose high yields is because they are expected to grow slowly. In fact, sometimes those companies are not even expected to last on the market for long. For example, the oil and gas companies. That is why you can see most of the oil companies offer high yields. As most companies and the government expect to shift completely to green energy in the following years, the oil sector is considered to be risky because it is highly probable that in the future 10 years, we would completely rely on green energies, and so the demand for oil and gas would decline tremendously. However, in the past months, you might have noticed that the oil sector might not collapse as quickly as expected because of the Ukraine war the inflation, and the rise of prices. Secondly, the other reason a company would propose a high dividend yield is corollary connected to the first one. As the sector in which the company operates is risky and unsure, they would propose a high dividend yield to attract investors, but only because their dividend is not safe. In fact, if the company has a high risk of collapsing in the near future, they will not be able to make any income and to earn money. Therefore, they will not be able to pay the dividend yields to the investors in the future. Furthermore, even though the company does not go bankrupt immediately, the fact that the dividend yield is high may result in a decline of the stock price for that company, which would then cause the company to collapse. So, I highly encourage you to do your research before investing in companies with high dividend yield. Generally, you might want to stick with dividend yields of 1 to 5%. For someone who wants a hands-on approach, buying a dividend ETF would be a great option in order to make decent profit. You could invest in an ETF like Schwab's SCHD, which is a very popular ETF amongst investors. This fund is great because it matches the return of the Dow Jones US Dividend 100 Index, which owns many companies like the Home Depot or Texas Instruments. With a reasonable amount of growth, this fund gets you 3% of dividend yield. This ensures that the value of your investments will potentially grow in the future. Also, if you invest consistently in it, you could easily arrive at the point where you make more than $500 from each month. On the other hand, if you want to make more money and benefit in the long run, you would want to invest in a growth ETF. If you want to receive higher overall returns, those are made for you. Investing in those ETFs may seem like you're not getting any profit from them, but the largest holdings are companies like Apple, Microsoft, or Alphabet. And as you acquire them, the growth of the holdings will outperform the market, and this will increase your dividend revenue over the years as you reinvest your profits, even though they pay a minimal dividend yield. Now that you know the different options, it is time to decide a strategy which you are going to use in order to invest and make a massive profit. Usually, investors at the beginning of their career focus on investing in growth. When you're a fledgling investor, it is the time to primarily focus on higher growth. This is the time when you are in your 20s, your 30s, and even at the beginning of your 40s, because during this time, income earned by your dividends is irrelevant unless you're planning to retire early. For this reason, someone who focuses on growth at their early stage will have better annual returns than someone who focuses on earning more dividend income. Now, as you age, become more concerned about the safety of your income and less concerned about growth, because you're preparing your retirements and are expecting to live with your dividend incomes. That is why the biggest decision to make concerning investing in dividends is whether you are planning to retire early or not. Subscribe and turn on the notification so you don't miss more videos about how to make money, personal finance, investing, and much more. Check out the latest video about the companies that will pay you more than $1,000 per month for investing in them.